Hey everyone, it's Serge Berger here. I wanted to remind everyone of the importance of limiting our drawdowns in our portfolios. And while that kind of may be an obvious thing to state, I just wanted to give you the pictorial form of what that means. And it's not just to avoid frustration and the near-termism of today's focus of many portfolio managers, but really this has profound implications on our retirement accounts, on our longer-term wealth growing capabilities. So on the right-hand side here on the screen, what you can see is the NASDAQ 100, which of course just had a drawdown last year. And my point here is, if you look on the left-hand side, is to remind people of how much money we actually have to make back in our accounts, depending on how much money we lose. So let's start very simply with a 20% drawdown. So meaning if our account drops 20%, we have to make back 25. That may not seem that extreme, but if your portfolio is down 30%, we have to make back 43%. And if our portfolio drops 50%, which during bear markets, ultimately many, if not most individual investors' portfolios do, we have to make back 100%. So instead of losing 50%, if we can say have drawdowns of 15 to 20%, that's a heck of a lot less money we have to make back than if we lose 50%, right? Even if we don't lose 50, let's say we lose 45% of the portfolio, we make 82%. So if we can limit our drawdowns to something more reasonable between 15 and 20, which is quite well reasonable within standard deviations, then we only, quote unquote, have to make back 18, 25%. That's much more doable than having to literally make 100% just to get back to break even. Now, the question, of course, is how do we do that? Well, of course, one of the things is being macro aware, being understanding of where we are in the global economic picture. And, one of the things that I'll leave you with here, and I've talked about this in a video here last week, is the importance of not ignoring what bonds are doing. The bond market is everything. We've had a major sea change in the way that interest rate policy basically is being implemented, meaning higher rates, probably higher for longer, not always going to be at these levels. They're going to go back down, then they'll go back up, but probably higher overall than what we had for the past decade. And that is an important sea change to be aware of, which means our asset allocation has to change. So much more into fixed income oriented products, which now give us equity-like returns, by the way, with like a fraction of the risk one had to take for the past 10 years to be investing to get the similar returns in much riskier assets. So anyway, I hope this is helpful, folks, and I'll talk to you soon.